My name is Jim Lockhart. I'm the moderator today. I lead the real estate practice for Wipfli throughout the firm, and I'm based in the Twin Cities here. And we've got an excellent panel with us. So why don't we just go down the row and let everybody introduce themselves. Phil?
My name is Phil Colton. I'm a partner at Winthrop and Weinstein, downtown Minneapolis. I'm chair of the Securities Law Department, do a lot of equity capital raising, represent many developers in this region. I also represent many real estate funds, as well as most of the REITs in this region, other than Grants REIT, Center Space.
Good morning, everyone. I'm Dannielle Lewis.
I don't think that's on.
All right, this is much better. Good morning, everyone. I'm Dannielle Lewis. I'm a tax partner at Wipfli. I focus about 90% of my time in our real estate group, and I work in our national tax office as well, trying to help our clients figure out the best tax strategies for their projects.
Hi, I'm Bill Keller. I'm a senior manager from Wipfli. I'm a senior manager at Wipfli. I'm actually from our Chicago North office. I do a lot of work in the low-income housing tax credit area, and looking forward to talking with all.
All right, great, thanks. So Dannielle, do you want to lead off our talk? Give us a legislative update, what's happening or not happening, or what do you think is going to happen? And given all that, tell us what we should be doing today.
Yeah, of course. So to kind of start, so we're almost 2 years into this pandemic, and nothing has kind of really changed on the IRS's side. So they're still very behind if we're thinking about how long it's taking people to get refunds, process letters, everything. They're still very far behind. Last time I think I spoke with the IRS, they're still opening mail from 7-8 months ago. But they're certainly not slow to send you a notice or a follow-up notice or something saying that they're about to seize your property. So it's been a really frustrating couple of years here dealing with the backlog that the IRS is kind of in, whether or not it's you getting a refund, ERTC credits, or even just processing amended tax returns. And unfortunately, there's not really any sunlight on the horizon there. Like, we're still going to be experiencing that over the next year. So I think that's just something important to keep top of mind, that that experience is kind of everywhere. It's not just maybe contingent upon whoever you're working with. Unfortunately, that backlog is real and is kind of affecting a lot of taxpayers in different ways. As far as like a legislation update, in the past year, we've kind of been a roller coaster of the possible tax changes. And right now where we sit, Build Back Better is still alive, theoretically. But what will get passed and what's included in it has substantially changed from where we were at a few months ago. A few months ago, we were looking at 1031 exchanges kind of being extremely limited. That's out. We're also looking at a lot of non-taxpayer friendly regulations as well. Most of those are out for now. They could always make their way back in. But the biggest impact of things that are kind of still alive in the bill is there could be a 3.8% additional surtax on business income over 400,000. Previously, this tax was really only on when you had portfolio income, so interest, dividends, something completely non-trader business related. And they're looking to apply that now to high income taxpayers with trader business income as well. So that could be a huge impact. There's also been on the state side, Minnesota had passed a pass-through entity tax election. This is something really important that if you have your own business to kind of meet with your CPA about. With the Tax Cut and Jobs Act, they eliminated your SALT deduction. So that's your sales and use tax deduction that you get on your tax return to $10,000. For most people, they kind of meet that just through property taxes and part of their year's wages. What this new pass-through entity tax allows is it allows your business to be able to deduct your state Minnesota taxes at the business level instead of you now getting limited and paying them at the individual level. So it's a huge potential opportunity to save cash. They implemented the rule in July. And I mean, there's still a lot of unknowns with it, certainly, a lot of questions that we are all kind of having as a practice and how it mechanically works. But it's something definitely to meet with your CPA about and kind of just check to see if that would apply to you, because it is a huge savings for a lot of people.
Dannielle, do you think some of these provisions will be retroactive, or when do you, I mean, if they get passed, what years would they apply to?
Great question. I have no idea. Unfortunately, I mean, they certainly have never been shy to do a retroactive law. That's what we've seen the last 2 years with all the CARES provisions that we've seen. Some of them going back even 2 years. So, I mean, that's reality that could happen of them retroactively doing some of those. Usually they're the ones that are the easiest to implement or ones that would save money versus the ones that are going to increase how much people owe. For example, that was a lot of the CARES reasons, is they wanted to increase people's cash flow by allowing them to go back and make different elections or provisions on their tax return. So hopefully with the increased ones, you know, we don't see those being retroactive. But I know one of the other things on the table was to increase that SALT limitation from that 10,000 to 80,000. That would be a huge benefit to a lot of people probably.
And what about capital gains?
Capital gains still are currently at the current rate, so 20% at the highest rate, which is great. I think there were a lot of people really afraid that they were going to increase those quite a bit in the last year. We saw a lot of people kind of doing either 1031 exchanges or something just to kind of be protective with the maybe property that they had that had appreciated in value a lot.
So what should we be doing now, still doing? Should we change some things up? I mean, what are your recommendations?
Yeah, for the most part, you know, it's hard to figure out what the legislation will look like. So for that, you know, kind of just remain where you are. We're going to keep seeing the legislation change, I think, with every administration. So it's hard to really plan ahead nowadays. So right now I would just say, don't change too much about that, but kind of look at different cost saving opportunities that you have. For example, if you've got a building, you know, is this a good opportunity for a cost segregation study? A cost segregation study is when you go into that building, maybe if we're looking at an apartment building, it'd normally have to be 27.5 years depreciation. We have like an engineer who goes in, does a cost segregation study and breaks that 27.5 years down into shorter useful lives. So maybe 5 and 7 year property that you can take bonus depreciation on. So you get 100% deduction that first year it's kind of placed into service. So that's a huge benefit for a lot of people. Also thinking in the apartment context, if you've got a building that is less than 4 stories and it kind of ground up development, looking at the 45L credit is a really great thing. That's going to be a tax efficient credit that you can get on your building, and it's $2,000 per unit once it's leased out. So that's usually a huge opportunity. If it's over 4 stories, you're allowed to take 179D, which is another energy credit, kind of like the parallel to the 45L. It's just it's not a credit, it's a deduction that you get to take. So that's kind of the difference. The 45L is a credit that you're going to take, and 179D is anything more than 3 stories that you're able to take as a deduction on your tax return. So I think looking at those are kind of a couple big tax saving strategies that you can look at that are easy to implement.
So kind of what we've always been doing.
Yep.
All right. Good. Bill, let's shift gears and talk about low-income housing. Talk to us about some of the IRS extensions, the Build Back Better Act, and some other ideas.
Great, thank you, Jim. Is this on? Okay. Better? How's that?
Good.
Okay, great. Talking about the IRS and things that they're doing and not doing, well, they did come up with some extensions for some of the front end work for low-income housing tax credits, pushing back, giving people longer time to meet their carryover for the first year that they're building the projects, because you know they have 2 years to develop the project and get through that. They've changed some when you place the building in service until 2023. They've given the projects that are in placed in service, and that should have been placed in service by at least 2022, moving those back to 2023. And they've also pushed back some lease up to make it easier to, since lease up's always been a challenge getting people in, they can take 6 months beyond when they placed it for the first year in credits. Not much else has changed in the world. Under the Build Back Better plan, which is the next thing that's up there. And obviously these are all, we have to wait for anything to pass, but some of the things that they talked about in there is higher credit level. Right now, everything's at a 9% tax credits on the eligible basis. And they're talking about making that at least from 22 to 24, going up to 10% plus the inflation rate, which is something that they haven't done for a while. The allocations that each of the states get has changed or would change under that, raising it up to $3.97 per capita. So depending on what the population of the state is, that's the amount of credits that they get. And some of the smaller states get a limit because they wouldn't make the $3.97 wouldn't help them that much, but limiting them, giving them a bottom line of $4.5 million in credits for each one of the smaller states. One of the other areas that they're working on is with relation to the passive activity bonds that are available through the housing authorities, that they can, the tax exempt bonds, instead of using 50% for your eligible costs, lowering that to 25%. So it'd make it easier for, you wouldn't have to spend as much. You could use other funding sources other than the tax exempt bonds, so they could give more projects those funds. And that would be from 2022 through 2025. And then the other thing that becomes in there is changing the basis boost for our eligible extremely low income projects from a 30% basis boost to a 50% basis boost, which allows more credits to be allocated to the projects. All of those items are all in Build Back Better. If it passes, then we can look at that and apply that to your projects. While talking about the credits, the credit rates that are being paid right now for the tax credits are anywhere from 84 to 95 cents a dollar for credits. So you've got, and they're very deal specific depending on what the investor likes about the deal, doesn't like about the deal. And then if it's in the city versus rural areas, the prices are different.
All right, great. Thanks, Bill. Phil, you have 15 minutes left. Talk to us about structures.
Sure, I'll try something different. What I'd like to talk about is coming into apartment building structures or real estate structures, and then mostly what we've seen in the past year, well, I shouldn't say mostly, but we've seen a number of very large sale transactions. So what I thought I'd talk about is coming into transactions and going out of transactions. And not a lot has changed, although there has been more focus on the sales side with 721 UPREIT transactions that Grant talked about. But on the coming into raising capital, equity side of transactions, things are still pretty much the same. People are using limited liability companies, limited partnerships to syndicate transactions. People are still coming into transactions on a tax deferred basis with 1031, and people are still using the opportunity zone tax enhancements, incentives when the property's on or in an opportunity zone. And what I would say is there hasn't been much change at the SEC or the securities law level, so the transactions are still very similar. When you're syndicating transactions, you can publicly advertise private placements now. I think everybody knows that. The main reason us securities lawyers shied away from doing that was there was a verification requirement that you had to verify that the investors coming in are accredited. And the SEC, before the Biden administration came in, loosened up that requirement slightly so that it's easier to establish verification. For example, you can rely on an accredited statement of a prior investor that's within the last 5 years. So you're starting to see a little bit more use of what I call public-private placements to raise capital. And that capital, as Timberland was talking about earlier, that capital is ready and available. We've seen many, whether they're funds for developers or just single property syndications, that capital is ready and available. On the opportunity zone side, that law is there. Dannielle and I talk about it very frequently. What I will say is you've lost the 15% basis enhancement that was in the statute, but you still have the major benefit of gains being tax-free after the property's been held for 10 years. And the main thing to think about if you do have a property in an opportunity zone or you're looking at a project like that is that statute requires tons of planning. What Dannielle and I talk about are the horror stories because people come in with situations not having talked with someone. It is definitely not a statute where it's ready, fire, aim. You definitely need to plan going into the transactions. You usually want a two-entity structure as opposed to what I heard someone describe the quality or opportunity zone funds as a ranch house. You want a two-story structure in most circumstances, so you have an easier threshold to measure against for the IRS. And then on the exit side, is very much, as everyone knows, tax driven. Everybody is looking for a tax deferred transaction. What we have seen an awful lot of recently are 721 UPREIT transactions. I did the 19 property KMS transaction with Centerspace and Grant. And the firm also did the recent Bader UPREIT transaction. And that's a very attractive structure for selling portfolios of properties. The 721, you get carryover and basis, you end up with an investment in either a public or I represent many private REITs that are looking for apartment buildings. And that is a very attractive transaction. 1031 is still out there. It's being used quite often. Everybody was trying to jam stuff in, of course, at the end of last year. What I would say on that is you can't pound a square peg into a round hole. Had a number of conversations where people were trying to put together joint venture transactions where it was two parties going into a TIC arrangement or a DST. And there are tax requirements and it's very hard to put a promote into a TIC structure. Actually, you can't under the RevProg. And the rules are pretty stringent on DSTs. So a lot of the same, but an awful lot of activity. And I would say the 721 UPREIT transactions were very significant. And Centerspace was a great partner to work with.
Well, yes. So the tick on the promote on the tick is very hard to do as it is with a DST. But are you seeing a lot of DSTs? I mean, we're seeing more and more DSTs people coming to us. Do you kind of want to explain what that is and why that's so attractive?
Yeah, if you don't know the way I explain DSTs, it's a Delaware statutory trust. And for simplistic purposes, the way I describe it is a TIC arrangement where instead of having 35 separate owners, each owning direct interest in the property, they own the interest in the trust, and the trust owns the property, and the common stock of the trust is syndicated and marketed more like a LLC or partnership. And we've seen a significant uptick in DST transactions. They're treated the same as interest in property, like TIC interest is. So you can 1031 the interest out on the backside. But the bankers like it because they're lending to one party, not 35 individual co-tenants. And the broker syndication market is very, very active. We all know the TIC syndication market was going crazy before 2009, and that blew up in 2009, 2010. It has come back rip roaring in the broker industry, and those they're using a DST structure. And I did 5 significant DST transactions in December. So the capital is there, lots and lots of capital looking for real estate interests.
Right. So is this,
We lost our sound.
we lost our sound? You can hear me okay? Well, you're right there. But yes, so DSTs are becoming more and more popular. They've been around for some time, since 2004, and they've been done on the coast, and we're seeing them come in here more. But there's some restrictions to using a DST, and sometimes I have people come to me and says, but I have an apartment building, I have multifamily. And there's these things called the 7 deadly sins associated with the DSTs. So Phil, how do you work around those in the apartment, mainly all the different leases that are involved?
Yeah, the principal deadly sins are you can't make improvements to the property and you can't refinance the property. That's the easiest way to think about it. And you can't enter into new leases or modify leases. And the way that that's addressed is the DST typically leases the property to a master tenant that is usually an affiliate of the sponsor, and the master tenant enters into the leases with the occupants of the property. So it's you can deal with changes in leases at the master tenant level.
Mm-hmm. Right. So we are seeing and helping structure DSTs for multifamily buildings as well. I have an OZ question. I know we're seeing a lot of OZs, so this is for Dannielle and Phil. I agree. I think the biggest benefit of an opportunity zone is the permanent deferral, or it's not a deferral, it's just tax exempt gain income when you sell the property, but you have to hold it for 10 years. And we have some clients that are in the holding period, but now they have great offers to sell their underlying building in the OZ. So it's like, how do they sell their building and still maintain OZ status? How long do they have to reinvest the proceeds? What do they have to invest it into? And what does that structure look like? Dannielle, you know.
Yeah, so we've definitely seen that a lot in the last year, either just from increasing housing market or, even different industrial spaces that people had OZ fund property in. So it depends on, what they're doing with it. The easy answer is if you've got your typical 2-structure QOF and QOZB at the bottom, the QOZB sells qualified opportunity zone property and shoots the proceeds up to the QOF. They've got 12 months to reinvest those proceeds into new property. A lot of people don't end up wanting to do that. It's a complicated question because it's like in all the ones that I've worked on, there's one person who ends up wanting out or wants to do their own thing. It's turning into like a 1031, like where people want out and some people want to stay in. So, I mean, there's definitely easy solutions that you can kind of work to create and make sure that you're maintaining the structure within the parameters that are out there. So it is an option. Like that is definitely not a deterrent. Like you can sell that underlying property. You could do a 1031 exchange. The big thing is trying to make sure that all the parties are kind of getting the outcome that they want out of it. Because the bad thing is if you're selling it within this 10-year period, you can't really get rid of the gain. There's no rule in that. So if you sold that underlying property, it's going to get kicked out onto K1 likely. Granted, you'd then have your own position to either defer that into a new opportunity zone or something else. But the one bad thing about that situation, unless you were to do a 1031 exchange, is you can't kind of avoid that gain that you're going to get within this 10-year period. So I've seen a lot of people kind of doing that, selling property. I've had a lot of fun structuring different ways for some people to stay in, some people to stay out. It's not necessarily complicated in a grand scheme, but it's something you have to plan for. You kind of can't do it on the back end and then trying to figure out what to do, similar to what Phil was saying. OZs definitely require a lot, working with someone with a legal and CPA team who really know the rules, because there's a lot of strange nuances to them that can overcomplicate what should be something really simple.
I would say that one of the nice things about OZs, if you have a property like that, is you only need to reinvest the capital gain. It's not the entire sale proceeds. And you can use capital gains from the stock market. If you have Apple stock and you sold that, you can reinvest as much of that capital gain as you want into the property. The problem is you're deferring your taxes on that gain till 2026. You got to pay the piper. And you hopefully have a property that refinances or something that gives you the cash to pay your capital gains. But you get into these situations like Dannielle's talking about, you need to reinvest, in your investment universe is much smaller than it is otherwise. And the other point I would say is, when we talk about flexibility, the nice thing about 721 UPREIT transactions. So for example, if you're UPREITing a property and you have 30 partners in your syndication, you're UPREITing it to center space, some of those partners can cash out. And in the KMS transaction, we had over 250 partners in the 19 different partnerships. And you can imagine dealing with that was fun. But there's the flexibility to deal with those situations that isn't necessarily always there.
Right, good answers. One last question and then try to get things back on track a little bit. So DSTs, we love them because of the structure. It gives everybody the flexibility to trade if they want to trade, or take their cash if they want to trade. What if I'm in an LLC right now? Can I move into a DST? And if, how long should I be a DST before I enter a sales transaction, or before I try to do a 1031? Phil, Dannielle.
Start. You want me to start?
You can start.
I would say the way I look at it is very similar to 1031 transactions. You're going to want to bridge tax year and not push the issue of drop and swap. So yes, you could move an LLC, a partnership, into a DST. We just recently moved beneficiaries of a trust into a DST. So it's very flexible, but once you get that DST stock interest, it's very similar. You're going to want to hold it and go through at least a couple quarter ends or a tax year end, so that you can establish a different operation and value to the DST when you go to 1031 that interest into another property or another DST. The other thing I would say is, given that the syndication market has gotten so strong, there is a lot of product out there. And we're seeing DSTs with 5, 10, 20 different properties. Vast majority of them are still single property DSTs, but we're seeing some that are 15 and 20 different properties supporting the DST.
Anything to add, Dannielle?
Not really, other than kind of the theme, I think, with DSTs ticks is you just need time. Make sure that if you're planning an exit strategy from a property, to just kind of start that early, just kind of even think through the solutions with your lawyer, CPA, whomever, just to kind of start thinking about that time process you would need for that. So you kind of have a game plan in the back of your head, so that you're not in a position where you're either trying to do a really interesting drop and swap, the day before you close on the property or something like that. Giving yourself that time will give a lot of flexibility and a lot of more thoughtful kind of transactions going forward.
All right, great. Well, I think that's our time. If there's any questions, we'll be here after this panel. You're going into break now, Jeff? Yeah. So we have a little tabletop out back, or you can come up here and we'd love to answer your questions. Thank you very much.